Hey traders, welcome back. This is a highly requested video, so I've kind of moved away from the order flow series, but check them out because we are going to be going over some order flow today, right? So this is gold on the 4-hour time frame. So I'm going to be going over an entire trade recap you could have taken on gold, and we're going to do the same thing on ES using the order flow. So this is something you want to be watching if you struggle with emotion, fear, any kind of psychological issues, right? So if you don't have a proper psychological stability, if you don't have psychological stability, what that means is that you're missing something in your edge because you can't build good technicals, or you can't build good psychology on bad technicals, right? So your technicals need to be in place, and the technicals are the easy part, right? Because if we break this down over here on gold, there's only 4 things I look for when it comes to higher time frame buyers, right? So we have a structural high and we have a structural high over here, right? So we saw a clear shift in the structure. Now from here, if we look at more recent structure, what we're seeing over here on gold on the 4-hour time frame is we see structure high, structure low, structure high, and then we had a break over here. This is the break, right? Then we had a structural high, structural low, and now we've had a break over here, right? So now from here, this structural low should really be over here because it's the lowest point before this high got broken. And now from here, we see price just continue to rip higher and higher and higher. So if we look at more kind of recent structure, the way that I would mark this out, we had a structural high, structural low, and we're just ripping, right? We're just ripping higher and higher on gold, right? We're just ripping. So the trade recap we're going to be going over today is pretty simple, right? So what we understand over here on gold, we need to position ourselves. So whenever you're trading on the higher time frames going down to lower time frames, when price gives us a high, we expect some kind of a pullback. Then price makes a high, we break structure over here. Then we see some kind of a pullback. Then we break structure over here again, and we see some kind of a pullback, right? So we're going to be going over a TGIF. A TGIF is simply a reversal that happens on a Friday, and the Friday's trade goes against the overall direction of the week, right? So let's break this down on the 15-minute time frame. So on the 15-minute time frame, the best trade you could have taken in the New York session would have been a sell, right? So here we have the daily power of 3. So my checklist for taking trades is very, very simple. I use the power of 3 merely as an easy confluence. You don't even need this indicator. But this is the power of 3 over here. So we always start off with our Asian session. Our Asian session, what's the purpose of the Asian session? So the Asian session has a purpose. It simply builds liquidity. The Asian session builds liquidity, right? So this liquidity building is very, very important, right? So when we have our Asian range, right, what we need to understand is we see that the price action takes out the Asian range high first, right? So let's break this down. So once we have the Asian range like this, we are simply looking for, as you can see, price heads lower before heading higher. So what we can see over here is quite fascinating, where we see the Asian low that gets swept. We see the Asian low that gets swept. So what happens here? What is the purpose of the market doing this? Because the market here, we're going over a power of 4, not a power of 3. We're going over a power of 4, which is important to understand. So we have our text over here. So this is the enticement of early sellers. This is what entices early sellers into the market. And the way we can see that is because price has taken out the Asian range low. So when price takes out the Asian range high, this is where we begin to look for a potential setup. So price has taken out the Asian range high just like this. So now that we're above the Asian range high, what this means by default is we're above the daily opening. So the daily opening is all the way down here. So quick tip, whenever you're looking for a sell trade, you always want to be trading above the daily opening, right? This is the most important thing to understand. So let's kind of break this down a little bit again, right? So what we have over here, let's go down to the 5-minute time frame. So on the 5-minute time frame, we're looking for an order block to take a potential trade from, right? It's really that simple. An order block is where you want to be trading from. And there's 3 things that validate an order block. So the first thing is we're looking for a market structure shift, right? The second thing we're looking for is a fair value gap, right? And the third thing we're looking for is a premium. And we're going to be discussing what we mean by this. So again, to give us some extra confluence and to give us some context, we are above the daily opening. So we're anticipating this to be the high of the day, right? So always use the power of 3 with some kind of context. We're expecting this to be the high of the day. The high of the day is the most important aspect because the high of the day tells us where we want to be selling from. We want to be selling as close as we can from this high of day, right? Very important to understand that. So now from here, let's break these concepts down a little bit further. So we see a structural high and a structural low. So we see some minor structure just over here, right? Minor kind of, nothing crazy. we need to see a change in the state, right? We need to see price shifting. So we see price giving us equal lows, which for me, for this particular setup, is just about good enough, right? So we see a shift over here, tiny shift over here. In fact, we see a more kind of solid shift over here. So this is what gives us our step number one. This is our market structure shift, right? So our step number two is we're looking for a fair value gap, right? So the fair value gap itself is just over here. This is our fair value gap. So this is our fair value gap just over here. So notice how we have the wick over here and we have the wick over here. They're not touching. And so this is an inefficiency. So fair value gaps is one of the most important concepts from ICT concept. It's probably the most important concept when it comes to finding high probability trades, right? So how can you validate your fair value gaps? Well, there's a few ways. The first is to understand we are trying to catch the high of the day. So this fair value gap is way above the daily opening. So when you want to be selling above the daily opening, it increases your chances of the trade actually working out. So that is step number one. Step number two is we've had a shift of structure to qualify this fair value gap. But step number three, if you look carefully, we have a structural high and we have a structural low. So notice how we have our 50% level over here. What does this 50% level represent, right? What does this here represent? This 50% level means that anything above it is in a premium. A premium is where we want to be selling from, right? So this is essentially our premium area. So we're waiting for price to come into this area and we want to see some kind of a reaction, right? What reaction are we looking for, right? The reaction is very good. So if you're somebody who doesn't want to place limit orders, you can execute live after a little bit more confirmation, right? So the confirmation you're looking for on gold is this, right? Notice how we come into this fair value gap region and we can't really close above it. We have these two wicks over here, 2 wicks in a row inside of a bearish fair value gap means that we have aggressive buyers that have failed, right? So whenever you see a wick, always remember we had buyers that were trying to drive price higher, but the market failed to do so. So when you see wicks, that's a good sign. Seeing wicks is a sign that the market is willing to reverse. So you can take a trade from this position with a stop loss just above the high over here, high of day. So you're essentially predicting a high of day. So now let's go to the 15-minute time frame and see where we can target, right? Where are you going to target? Targets are very important, right? So I don't like to hold my trades for a very, very long time because they could reverse on me. I could get stopped at a break even. I could even lose the trade, which obviously messes with my psychology. So one thing I like to do is I like to be very fixed with my kind of targets, right? Targets are very important. So you want to be simply targeting a fair value gap from the London session. So if you're trading New York session, target a fair value gap from the London session. So this is an inefficiency from the London session. If we go back to the 5-minute time frame or even now the 1-minute time frame, we can simply target this low down here, right? So it's really simple, right? The strategy itself isn't difficult to understand, right? If we go down to the 5-minute time frame, we can see how price eventually melted down in our favor, right? So how did we take this trade? What was the basics? What was the basis for taking this trade, right? If we quickly go over this. Right, so step number one, of course, we had our Asian session. We're looking for early sellers. These early sellers get enticed and they get stopped out. This is the ICT Judah swing. So the ICT Judah swing is, of course, something I look at in a lot of detail. So the ICT Judah swing, right, when you're looking for a Judah swing, it has to be above the daily opening. Above the daily opening, right? This is the first thing you're looking for. It has to be above the daily opening. And therefore, by default, it's going to take out the Asian range high. So when we look at our power of 3 indicator, our power of 3 indicator is down here. Notice how we're way above the daily opening and we're simply looking to catch this kind of wick over here. The secret to taking the best selling trades is to try to sell as close as you can to that high of day and target a London fair value gap. This gives you a good kind of basis on how to trade, right? Now let's move on to ES. So here on ES, we start on the 15-minute time frame, more of a kind of an intraday scalping position. Notice how we have my 3-step process. I've gone through this in many videos before. Highly recommend checking those out. We start off with our 15-minute fair value gap. So our 15-minute fair value gap essentially gives us our location. So if we just label this M15, this is step 1 of the strategy, right? 15-minute fair value gap. This is the key level. So if we don't have a key level, we can't take any trades, right? 15-minute fair value gaps are the lifeblood to your trading as well as my trading, right? Step 2 is you're looking for the 1 minute to enter this area. So looking for a 1-minute entry. And step 3 is you're looking for the order flow. Order flow is the most important thing. I've made about 10, 15 videos on this, so I highly recommend checking that out. We're not going to go through this in too much detail because this is just a simple case study. So we can see over here the 15-minute fair value gap has been given. A quick note on the fair value gap. I want traders to understand one thing. What makes a key level high probability? What makes a key level high probability? So we need to leave a fair value gap. That's kind of a rule, right? But we're always looking to use the candle before the fair value gap. People get mixed up on this. You're using the candle before this fair value gap over here. Important note to understand that. The second thing is we have some inducement resting over here. Inducement means liquidity. So when the market comes down to this region, we're simply looking to take out liquidity. So think of liquidity as fuel. Liquidity is fuel, and you're simply using it as an inducement. This is important to understand, right? So whenever you see this, this is simply inducement. Inducement is very, very important. So now from here, we go down to the 1 minute time frame and we begin looking for some kind of an entry. Okay, so the first thing is this is not a valid mitigation. This is a wrong mitigation. The reason why is because you're looking for the market to enter with a body, right? This is a wick. We want to see the bodies entering inside the key level. So now that we've come inside of this area, we're now looking for potential order flow. So we can see we're inside of a 15-minute fair value gap. So what are we looking for, right? So now that we're inside, we have our step 1 and step 2 underway, right? So what was step 3? Step 3 is the order flow. And in particular in the order flow, we're looking at two things, right? So we're looking at the volume. That's the first thing. We're looking at the volume. And we're also looking at the delta. These are the two things we look for. So if you're inside of a fair value gap and you're just trading blindly off fair value gaps, there's no way you can actually become profitable, right? I'm going to explain to you why that is, right? So if we go over here on ES, this is the same exact price action, but I'm going to kind of draw your attention now to the 5-minute time frame. So on the 5-minute time frame, right, which also of course represents the 1-minute time frame, you want to understand what's going on behind every single candle. So we can see over here, the candle here, we have so many aggressive sellers, right? We can see that via the delta. If we look at the volume over here, notice how we have numbers in the hundreds. So we see 356 for 302. But if we look at the bottom, we see 22 for 0. This is a volume indication. The volume has decreased. So when we go back to the regular candlestick chart, what you need to understand is in this region, we saw two things. We saw the volume had decreased, which is a good thing. And we saw the delta, we saw negative delta, which means aggressive sellers have failed. So aggressive sellers are trying to break this zone, but of course they haven't done that, right? They have failed. Look at all these aggressive sellers. They have failed to drive price lower. They've in fact drove price higher, which means that sellers are not in control. Buyers are in control, and we can only see that with volume and delta. So if there's one thing you take away from this video is understand the bid and the ask, and understand there's no way of trading profitably without it, right? So forget what the power of 3 indicators say, the gurus. You need some context. You need context in your trades, right? Very important. Now from here, we're going to be looking for a potential retest, right? So we're looking for a retest, right? This is where you can start to use fair value gaps a little bit. So to give you some context, we're inside of a 15-minute fair value gap, and the 1 minute has given us a fair value gap over here, right? The 1 minute has kind of given us this imbalance over here. So I'm going to change that to a different color so we can see that. The 1 minute gives us an imbalance over here. And what's super interesting is this. We simply wick and run the other way. We see a wick before the market runs the other way. But what makes this wick extra valid is when you look over here, let's look at this wick over here. It's super interesting how we had so many sellers in the level again. So when you see so many sellers in the level, but the market fails to break below that level, it means that the zone is strong, right? These are aggressive sellers, right? We see the bid getting hit consistently, right? 48 for 0, 386 for 165. So we see so many aggressive sellers, but none of them have been rewarded. So if none of them get rewarded, what that means is that this zone is strong, and we see a wick rejection. A wick rejection is what you want to see. So you can take a trade over here with a stop loss just kind of below this fair value gap over here, right? So now the question is, where do you target? So I like to target at least a 1 to 2 hour trade. The price ran a little bit further than that, but a 1 to 2.5 hour trade is very easy and it can keep the bills away, right? So this is kind of in trade recap on both gold and ES. And if there's one thing you want to take away from this video is you want to wait for a 15-minute fair value gap, 1 minute for entry, and order flow to confirm everything. Order flow, order flow. Without order flow, you can't trade, right? So if you like this video, give it a like and thumbs up, and I look forward to seeing all of you in the next one.